Hello, I'm Manoush Samarodi reporting for World Risk and Insurance News. In this edition of RIN TV, we welcome back the Insurance Insider with a report from London on industry news and insights. We also have a special report from Nathan King at the NASDAQ market site in New York, where he'll look at the ups and downs of global markets over recent weeks. And in another Asia Pac in Focus, host JP Schmidt interviews executives from Strategic Risk Solutions and Beecher Carlson. This and more from the online video news network for the global risk and insurance community. You're watching World Risk and Insurance News.
From our news bureaus around the globe, this is World Risk and Insurance News.
We begin with a special report from the Insurance Insider. I'm joined by Rebecca Bohl, publishing editor at Insider Publishing. Now, as the year winds to a close, it seems all eyes are on the accumulating flood losses in Thailand. Why has this event become so important?
The Thai floods are shaping up to be a market-changing event, coming on top of a series of natural catastrophes from around the globe, which are predicted to cost the reinsurance industry north of $90 billion. The Insurance Insider's coverage of the Thai losses has been market-leading, and in December's issue, which was published earlier this week, we ran a special market report on the Thai loss situation, including loss estimates, insurance market shares, and we also calculated the proportions of Thai losses that may hit the international and the retro markets. Insider sources in the region and in the global reinsurance community are regularly putting the insured loss estimates between $10 billion and $15 billion, with outliers becoming more vocal in the loss range of between $15 and $20 billion. And our reporters have calculated that up to 75% of losses from the Thai flooding are likely to end up in the reinsurance and the retrocession markets.
Rebecca, January 1 renewals are just around the corner. What themes are emerging during this crucial renewal season?
The Insurance Insider has gained consensus from its underwriting and broking sources that rate increases of between 5 and 15% are likely to be achieved at the 1st of January. The combined effects of cat losses, model changes, the high cost of equity capital and low investment returns have tipped the market, at least for US cat cover. And as one underwriter told the Insurance Insider, it appears to have tipped the market in a way that a shock US wind loss may do. But of the significant number of European and US accounts with a January renewal date, only a handful of firm orders have so far materialised in the market. The majority of buyers and sellers have been holding back to get a better sense of market sentiment and price discovery.
Thank you so much, Rebecca. We look forward to having you as a regular guest on World Risk and Insurance News. So we turn our attention now to fluctuating stock markets. The insurance industry is not immune from the turbulence affecting financial markets around the world. Financial performance at major insurers has suffered, as have their stock prices. Here with a report on the impact of global markets on the insurance industry is Nathan King from the NASDAQ market site at Times Square.
Yeah, the recent volatility in global stock markets has by no means left the property and casualty sector unscathed. Stocks have been in whiplash for months, including a recent 13% jump in the S&P 500, coming as fears of a European crisis dragging down the rest of the world into a broader recession appear to fade. And while the property and casualty stocks have mirrored much of the market action, there are some added downward pressures unique to the stocks in the sector. The NASDAQ Insurance Index, for example, hit a low in mid-August along with the rest of the market, but has since bounced back, albeit with volatility. And compare the charts of travelers here in the US, for example, with other insurance companies, Zurich Financial and the RSA Insurance Group in London, and you will see this trend going on. But industry-wide, there are some factors to consider which separate the property and casualty stocks from the rest of the market. Ratings agency Moody's recently said that Q3 net income for the sector was down 70% from the same period last year, partly due to continued heavy cat losses like Hurricane Irene and floods in European countries and Thailand. Other ratings agency Fitch also noted that underwriting results have deteriorated as the year has progressed. And recent commentary on the global economic crisis has also depressed insurance stocks, suggesting that a second downturn here in the US or Europe could affect a cyclical recovery in premiums anticipated for the end of 2012 or the beginning of 2013. Is there a silver lining? Yes, if the macro economic picture picks up. Remember, after all, last week we saw a big drop in the US unemployment rate. A pickup in the US economy could bode well for increased premium income in the insurance industry. In addition, a recent survey with the Council of Insurance Agents and Brokers said that carriers are getting rate increases for the first time since 2003, again, due to the impact of cat losses on insurer capital mainly. However, the survey also indicates that headwinds are strong for 2012 and beyond.
Thank you, Nathan. Now, J.P. Schmidt, former insurance commissioner for the state of Hawaii, returns with another edition of Asia Pac in Focus. Here, J.P. sits down with executives from Strategic Risk Solutions and Beecher Carlson to discuss recent trends in captive management.
Asia Pac in Focus, brought to you by the Hawaii Captive Insurance Council.
Hello, I'm J.P. Schmidt. Welcome to our show, Asia Pacific in Focus. Today I have with us Derek White, President of Strategic Risk Solutions. What has been happening with group and cell captives?
Group and cell captives, we've had a lot of association captives form, but not for the normal P&C business, more for medical stop loss is what we've seen. And they've actually been doing it through cell captives. We have a couple of programs going on where they'll join a cell and basically self-insure the medical stop loss in a trust and then reinsure from the trust into a captive. It's not a MIWA, and you have to be careful that it's not, but it's been pretty successful for the few that we formed, and I think that's going to be a trend, not only for SRS, but for a lot of domiciles out there.
And what has been going on with risk retention groups lately?
Primary push is still medical malpractice for doctors, professional liability, but there's also been a whole lot going on at the NAIC, National Association of Insurance Commissioners. There was a GAO report out back in August of '05, which I think you were involved with too and helped out with, and one thing they said is they need more consistent regulation and consistency in accounting rules across the states to make them more accepted and hopefully improve the regulation of risk retention groups. The NAIC has taken that to heart, and they're making RRGs follow all 18 model laws that traditional companies have to follow. The non-domiciliary states might be a little bit more accepting of RRGs, and that's a good thing for all risk retention groups. They're now accepting of GAAP accounting, letters of credits, approval of reinsurers rather than commercial reinsurers, and overall I think the whole regulatory trend is changing to like risk retention groups a little bit more and help support the Federal Act.
Today I have Gregory Myers, Executive Managing Director of Beecher Carlson, with us. What trends do you see developing in the captive industry?
Well, I think the one thing we've seen is that a couple of years ago, few people did close down captives with the economic downturn. Most people are keeping their captives and they're looking for new ways to use them, and they're also setting themselves up concerned that there may be a market trend, particularly on the property side, over the next year or two.
Can you discuss how a multi-captive global program can be of benefit to an international company?
Well, we see a big benefit in putting together a global program so you can get consistency of coverage and tends to be broader coverage across the board throughout all of the locations a corporation may have. They then can better manage the use of their retentions, potentially with the use of different captives, looking at tax and regulatory issues, and then using those captives to meet different retention needs that they may have for their operations in different parts of the world, either due to regulatory reasons or to personal preferences from how risk adverse they are or the type of coverage that they're looking for in a certain country.
Can you explain for us Beecher Carlson's Zoom process and how it helps control workers' compensation costs?
What Zoom does is it looks at workers' compensation claims in 4 separate buckets. Old claims, those over 2 years old, which we tend to look at a claims closure project. Recent claims, those within the last 2 years, and we've used predictive analytics to look at adverse development that may be occurring with those claims and to better project it so that we can direct the right actions to reduce those losses. In existing claims, we look at on a weekly basis and make sure anything that jumps out through our predictive analytics feature, those can be addressed and reduced, and then using that to emphasize loss control methods to reduce future claims.
Well, that's our report. I'm Manoush Zomorodi reporting from New York. Join us next time for more world risk and insurance news on RIN TV.